Hello and welcome to the video about creating a plan and using technicals. A very important part of trading which will take us through some key learning outcomes. So let's see what these are. What you need a trading plan for, how to create a trading plan, key elements to remember, and always do a plan before you decide to trade. So why do you need a plan then? Here is a very famous saying that if you fail to plan, you're planning to fail. This is very much the case in trading. Traders often think that once they have set up their charts and funded their account, that they are ready to trade. That all it takes is read the news, draw your analysis on the charts, and read few books on trading and on what successful traders have done, and that is it. This is a common mistake. You've got to have your trading roadmap in place even before you start your journey. Some novice traders try to implement that by choosing to trade on a demo account for a while. Demo account would more often than not mean that you are testing a software or the markets on a live feed, live prices, but with mock money. Traders put in place a plan and trade for a few weeks. Then they go live with a real account and find out that reality is different. Why do you think that this is the case? Because a trading plan without the real circumstances taken into account is not complete. Because your decisions will not be based on true psychological biases that you will face when trying it live. A demo account in all aspects is not one that replicates the true market environment. It just helps you get an idea of what you might expect out there. So please bear that in mind. A trading plan then not only prepares you for the actual trades you're going to do, but also allows you to have a way of trading that you can repeat. This is the key to being a consistent, profitable trader. History tends to rhyme, and so a more experienced trader will be able to identify similar patterns which resemble past actions, therefore giving him an edge. If you know the reasons you won a trade, you can repeat it. If you know the reasons you lost a trade, you can cut it out. It sounds simple, but most traders do not do this. A plan helps you with 1. Trade entry. Where and under which circumstances do I open a position, whether long or short? What position size will I use? 2. Trade exit. More importantly, where do you exit a trade? How much is enough? 3. Running trades. How do I manage my positions? Adjusting trailing stops, partial closure of winning trades. 4. Psychology. Getting used to taming your own behavioral traits, your eagerness to cut short your gains, and your habit to let your losses run, for example. Your tendency to trade what other people think is correct at the time. Your eagerness to get confirmation from other fellow traders for whom you haven't got the faintest idea of whether they're good or trustworthy. These are just some examples. And 5, for when it all goes wrong. So basically, everything you need to become a successful trader yourself. All aspects of trading are important. It can be argued that the reason you press the button to buy or sell, to trade, are the most important. A technical trade will be based on your charts, the candlestick formations, the indicators or oscillators you look at, support and resistance, patterns, etc. You will be basing your trading decision on the assumption that the chart is actually depicting all the necessary information. That if something happens in the market, the chart will be the first to know. A fundamental trade, on the other hand, will be based on news, economic data, key speakers, or global events such as terror attacks. A common practice among traders is to use 80% technical and 20% fundamental information to make trading decisions. An impulse trade is where you just had a hunch. Simple as that. There is nothing wrong with this, despite what a lot of trading education states. It is, however, harder to replicate a hunch than it is to repeat an established fundamental or technical trade. A trade based on hunch tends to be erratic and so difficult to repeat. So this comes with experience, because trading resembles more of a marathon than a sprint. Now going back to the trade entry. With a technical trade, you can see exactly what you're looking at on your charts. In this instance, you are selling due to a trend line and the oscillator, the relative strength index, being above 70, marked with a light blue frame at the lower part of the graph, which is considered overbought. In this case, you would sell based upon your technical reasons. This is a simple trading plan idea. As you get to know more and more about the tools that technical analysis offers you, you will appreciate that there are many ways to help you make a decision. And this is where the problem starts, as traders then tend to use many different indicators and systems. But most of the times, the answer is in simplicity. In the fundamental cell, you're looking at key European data. In this instance, the trade balance is lower than forecast, as you can see on the screenshot. You may then decide to sell European stocks or the euro against another currency. These are all things that can be replicated. You can repeat these two types of trades in the future. This is where having a plan or some way of referring to how you came up with trade ideas helps. Of course, it goes without saying that if you have a good idea of why you got into a trade, you can use the opposite of this idea to exit a trade. So we have solved the cable, the British pound against the American dollar, because of the trend line and the RSI, the relative strength index, being at 70. When the market moves lower and the RSI gets towards 30, which is considered to be oversold, we can then exit the trade. You can see all these points of entry and exit marked with the light blue frames as well as the red ones for exit. You can, of course, refer back to your risk-reward ratios or have a set monetary amount as your target. Again, is what you can repeat and what is in your trading plan. The more often you repeat this, the more consistent you will become as a trader. When planning how long to hold your trades for, it is very important to have an idea well before you place a trade. It goes without saying that the longer you hold the trade for, the more money you can potentially make, but you also have an idea of the risk you have taken and make sure it is in balance. Their two charts look similar, but the daily chart is to get an idea of direction and the trend. The hourly chart is where you will be buying or selling. This is the same notion as operating on a multiple time frame basis. You need to be aware of the bigger picture, but also of your specific time frame. If you start to hold trades for days, you have more of an investing mindset than trading. Therefore, your trading risk, trade entry, and exit plan will have to reflect this. You can't simply just hold every trade indefinitely. If you try to do this, the risk you take by time exposed to market movements will generally catch you out and you will lose money. Investing requires a different mindset. To put it in a nutshell, investing would typically require a much longer investment horizon and most probably different products, including bonds, holding stocks for dividend yield, and so on and so forth. While trading will entail short-term movements with the use of technical analysis as well as more versatile products like options and futures or the use of leverage. So we should not be confusing these two in our mind. They come with different set of goals and risk management. Now coming on to trading psychology, a big factor in our trading plan indeed. In a perfect world, you would take a trade based on the technicals or the fundamentals, allocate your desired risk, and that would be as hard as trading gets. Unfortunately, you have other people in the markets. This created fear, greed, and irrationality. Besides, the market is just the sum of different opinions and biases, that of market participants. And not only do you have to trade against others, but also against yourself. Trading psychology, or simply being aware that markets may not always move in a way you want them to, is important. It should be in your plan. What do you think and why? What does the market want you to think and why? They are rarely the same. Moreover, why did you lose even when your trading call was correct? What do other people think about a trade or a situation? Trading in herd behavior or choosing to be a contrarian? These are just few of the questions that this burning issue addresses. And more often than not, they are the most important. So, as a trader, you're hunting for value. You want to buy low and sell high, obviously. Or buy high and sell higher. If we all know this, then we should be mentally prepared that it may not be as simple as that. If everybody in trading has the same aim to make money, do we really think that the markets will act fairly and allow everyone to make the money they want? Of course not. This is why markets tend to move in such a way that it puts people in a position where they get out of what would be winning trades for a loss. It all comes back to fear and greed, but also the fact that the majority of the participants or wannabe traders are trying to make the market pay for their needs and utility bills. A tragic mistake, as you can imagine. Have you ever thought what the markets want you to think? Have you ever heard of the phrases stop grabber, pin bar, short squeeze? They are all terms that are used in the markets to describe some of the short-term market movements. If you are selling the markets and you experience a short squeeze, what do you think is happening? The market knows that traders like yourself are short or selling, so the market moves up very aggressively and quickly so that traders liquidate their positions for a loss. The market then comes back and does exactly what the majority of the other traders thought. This short squeeze is how big traders, banks, institutions make more money. They take your thinking and use it against you for their own profit. Sounds familiar? By being aware in your trading plan that this happens, you can deal with this potential scenario. There are many sayings in life, and especially in trading. Part of your trading plan should be when enough is enough. There are no prizes for those who make the biggest loss. Everyone dislikes losing trades. It's normal. It is important when you have a trading plan that you know when things have gone wrong and when it is simply time to get out. It is a lot easier to make £1,000 back than £3,000 back, and when trading goes wrong, the amounts can jump up quickly and take you by surprise. Think about this simple trade. You buy something at 100 and you sell for a 50% loss, that is at 50. The same underline to go back in value at where it was, that is at 100, it will take 100%, not 50%. Tricky, huh? You should always have a plan that allows you to get out before you do too much damage to your capital. So this is also the role of your risk management and disciplined actions, which we examine separately. Your trading plan is just that, what you want to get out of trading. This can be as simple as a set of instructions or a handwritten set of steps. It can be a spreadsheet or more formalized business plan approach. At the end of the day, it has to be something you refer to. You have to know why you took the trades you have and also have some idea if you can repeat that. It is like planning for anything else in life. Would you not plan to buy a car or a house? Would you not plan to make an investment as a business owner? I bet you would. Well, trading is pretty much the same. After all, you are staking your own money just like in these previous situations. Why treat it differently? It doesn't have to be fancy. It doesn't have to be the only way you ever trade. The most important part of trading plan is that you have acknowledged that you have thought about what you're doing and, more importantly, why. This will only ever make you a better trader.